Hi viewers, I am Dr. S. Chandra, Assistant Professor of Commerce, Sri Sarada College for Women Autonomous, Salem. Today we are going to discuss something about financial management. Business concern needs finance to meet their requirements in the economic world. Any kind of business activity depends on the finance. So we called finance as the lifeblood of business organization. Whether the business concern are big or small, they need finance to fulfill their business activities. Financial management may be defined as planning, organizing, directing and controlling the financial activities of the organization. Goodman and Dougal also defined financial management is the activity concerned with planning, raising, controlling and administering of funds used in the business. Massey also defined financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. Now we are going to discuss the characteristics of financial management. The first characteristics of financial management, it is an essential part of overall management. Financial considerations are involved in all business decisions. Financial management is pervasive throughout the organization. The central focus of financial management is valuation of the firm. That is, financial decisions are directed at increasing or maximizing or optimizing the value of the firm. Financial management essentially involves risk-return trade-off decisions on investment. It involves choosing of types of assets which generate returns accompanied by risk. Generally, higher the risk, returns might be higher and vice versa. The financial manager has to decide the level of risk of the firm can assume and satisfy with the accompanying return. Financial management affects the survival, growth and strength of the firm. Finance is said to be the lifeblood of business. The amount, type, sources, conditions and cost of finance squarely influence the functioning of the unit. Finance functions, that is investment, raising of capital, distribution of profit, are performed in all forms, business or non-business, big or small, proprietary or corporate undertakings. Financial management is a subsystem of business system which has other subsystems like production, marketing, sales, etc. In subsystems arrangement, financial subsystem is to be well coordinated with others and other subsystems well matched with the financial subsystem. So finance plays an important role, and financial management is also play an important role in the business organization. Now we are going to discuss the scope or elements of financial management. We have three elements of financial management. The first one is financing decision, the second one is investment decision, the third one is dividend decision. First we discuss the financing decisions. Managers also make decisions pertaining to raising finance from long-term sources and short-term sources. Financing decisions have two types. The first one is financial planning decisions, the second one is capital structure decisions. Financial planning decisions which relate to estimating the sources and application of funds. It means pre-estimating financial needs of an organization to ensure the availability of adequate finance. The primary objective of financial planning is to plan and ensure that the funds are available as and when required. The second financing decision is capital structure decisions, which involve identifying source of funds. They also involve decisions with respect to choosing external sources like issue of shares, bonds, borrowings from banks or internal sources like retained earnings for raising funds. Some of the factors affecting financing decisions. The first factor is cost. Financing decisions are all about allocation of funds and cost cutting. The cost of raising funds from various sources differs a lot. The most cost efficient sources should be selected. The next factor is risk. The dangers of starting a venture with the funds from various sources differ. Larger risk is linked with the funds which are borrowed than the equity funds. This risk assessment is one of the main aspects of financing decisions. The next one is cash flow position. Cash flow is the regular day-to-day earnings of the company. Good or bad cash flow position gives confidence or discourages the investors to invest funds in the company. The next factor is control. In the situation where existing investors need to hold control of the business, then finance can be raised through borrowing money. However, when they are preferred for reduced control of the business, equity capital can be utilized for raising funds. The last factor is condition of the market. It is a lot for financing decisions. During boom period, issue of equities is a majority, but during a depression, a firm will have to use debt capital. These decisions are an important part of financing decisions. Now we discuss the second element of financial management, that is investment decisions. Managers need to decide an amount of investment available out of the existing finance on a long term and short term basis. The investment decisions have two types: long term investment decisions and short term investment decisions. Long term investment decisions, otherwise called as capital budgeting. It means committing funds for a long period of time like fixed assets. These decisions are irreversible and usually include the ones pertaining to investing in a building and or land, acquiring new plants, machinery or replacing the old ones. These decisions determine the financial search and performance of a business. Short-term investment decisions is otherwise called as working capital management. It means committing funds for a short period of time like current assets. These involves decisions pertaining to the investment of funds in the inventory, cash, bank deposits and other short-term investments. They directly affect the liquidity and performance of the business. Some of the factors affecting investment decisions also. The first factor is cash flow of the venture. When an organization starts a business enterprise, it invests a huge capital at the start. The organization expects at least some form of income to meet day-to-day expenses. There must be some regular cash flow within the venture to help it sustain. The second factor is profits. The basic criteria for starting any venture is to generate income but moreover profits. The most critical criteria in choosing the venture or the rate of return it will bring for the organization in the nature of profits. For example, if venture A is getting 10% return and venture B is getting 15% return, we choose the best one, that is project B. The next factor is investment criteria. Different capital budgeting procedures are available to a business that can be utilized to assess different investment proposals. These are based on calculations with regard to the amount of investment, interest rates, cash flows and rate of returns associated with the proposals. These procedures are applied to the investment proposals to choose the best proposal. Now we are going to discuss the last element, dividend decisions. These involve decisions related to the proportion or portion of profits that will be distributed as dividend. Shareholders also demand a higher dividend while the management would want to retain profits but business needs. Hence, it is a complex managerial decisions among the remaining two elements. Some of the factors also affecting dividend decisions. The first factor is earnings. Returns to investors are paid out of the present and past income. Consequently, earning is the noteworthy determinant of the dividend. The next one is dependability in earnings. An organization having higher and stable earnings can announce higher dividend than an organization with lower income. The next factor is balancing dividends. For the most part, organizations attempt to balance out dividends per share. A consistent dividend is given every year. A change is made if the organization's income potential has gone up and not only the income of the present year. The last factor is development opportunity. Organizations having great development openings, if they hold more cash out of their income to fund their required investment, the dividend announced in growing organizations is smaller than that in the non-development companies. Now we are going to discuss the next topic, role and functions of financial management or financial manager. The first function is financial decisions. Financial management and financial managers play a crucial role in making financial decisions and exercising control over finance in the organization. The second function is financial planning. The finance manager is responsible for the planning of financial activities and resources in the organization. To this end, they use available data to understand the needs and priorities of the organization as well as the overall economic situation and make plans and budgets for the same. The next function is estimation of capital requirements. This will depend upon expected cost and profits and future programs and policies of the concern. Estimations have to be made in an adequate manner which increases earning capacity of enterprise. The next function is determination of capital composition. Once the estimation has been made, the capital structure have to be decided. This involves short-term and long-term debt equity analysis. This will depend upon the amount of equity capital of a company, its positioning and additional funds which have to be raised from outside parties. The next function is choice of sources of funds. For additional funds to be procured, a company has many choices like issue of shares and debentures, loans to be taken from banks or financial institutions, public deposits to be drawn like in the form of bonds. Choice of factor will depend on relative merits and demerits of each sources and period of financing. The next function is investment of funds. Finance manager has to decide to allocate funds into profitable ventures so that there is safety on investment and regular returns is possible. The next function is cash flow management. It is extremely important for organizations to have sufficient working capital and cash flow to meet their operational expenses and emergencies. Financial management tracks account payable and receivables to ensure there is sufficient cash flow available at all times. The next function is disposal of surplus. The net profits decisions has to be made by the finance manager. This can be done in two ways, that is dividend declaration and retained earnings. Dividend declaration includes identifying the rate of dividends and other benefits like bonus. Retained profits, it has to be decided which will depend upon the expansion, innovation and diversification plans of the company. The next function is financial reporting. Financial management maintain all necessary reports related to the finance of the organization and uses this as the database for forecasting and planning financial activities. The next one is risk management. Sound financial management prepares the organization to forecast risk, put in place mitigation plans as well as to meet unforeseen risks and emergencies effectively. The next one is management of cash. Finance manager has to make decisions with regard to cash management. Cash is required for many purposes like payment of wages and salaries, payment of electricity and water bills, payment to creditors, meeting current liabilities, maintenance of enough stock, purchases of raw materials and so on. The last function is financial control. The finance manager has not only to plan, procure and utilize the funds, but he also has to exercise control over finances. This can be done through many techniques like ratio analysis, financial forecasting, cost and profit controls and different techniques. So, financial manager play an important role in the business concern. Now we are going to discuss the objectives of financial management. We have basic objectives and additional objectives. In basic objectives, we have two objectives, profit maximization and wealth maximization. In profit maximization, main aim of any kind of economic activity is earning profit. A business concern is also functioning mainly for the purpose of earning profit. Profit is the measuring techniques to understand the business efficiency of the concern. The finance manager tries to earn maximum profits for the company in the short term and long term. He cannot guarantee profits in the long term because of business uncertainties. The second objective is wealth maximization. It is also a main objective of financial management. Wealth maximization means to earn maximum wealth for the shareholders. The finance manager tries to give the maximum dividend to the shareholders. He also tries to increase the market value of shares. The market value of shares is directly related to the performance of the company. Better the performance, higher is the market value of shares and vice versa. So the finance manager must try to maximize the shareholders' wealth and also values. The next objectives, additional objectives. We have some additional objectives also. The first one is proper estimation of total financial requirements. The finance manager must estimate the total financial requirements of company. He must find out how much finance is required to start and run the company. He must find out the fixed capital and working capital requirements of the company. His estimation must be correct. If not, there will be shortage or surplus of finance. Estimating the financial requirements is a very difficult job. The finance manager must consider many factors such as the type of technology used by the company, number of employees employed, scale of operations and legal requirements. The second objective is proper mobilization. Mobilization of finance is an important objective of financial management. After estimating the financial requirements, the finance manager must decide about the source of finance. He can collect finance from many sources, shares, debentures, bank loans, etc. There must be a proper balance between own finance and borrowed finance. The company must borrow money at a low rate of interest. The next objective is proper utilization of finance. The finance manager must make optimum utilization of finance. He must use the finance profitable and not waste the finance of the company. He must not invest the company's finance in unprofitable projects and not block the company's finance in inventories. The next one is maintaining proper cash flow. The company must have a proper cash flow to pay the day-to-day expenses such as purchasing of raw materials, payment of wages and salaries, rent, electricity bills, etc. If the company has a good cash flow, it can take advantages of many opportunities like getting cash discount on purchases, large scale purchasing and giving credit to customers. Healthy cash flow improves the chances of survival and success of the company. The next objective is survival of company. The company must survive in this competitive business world. The finance manager must be very careful while making financial decisions. One wrong decision can make the company sick and it will close down. The next objective is creating reserves. The company must not distribute the full profit as a dividend to the shareholders. It must keep a part of its profits as reserve. Reserve can be used for future growth and expansion. It can also be used to face contingencies in the future. The next objective is proper coordination. Finance management and financial manager must try to have proper coordination between the finance department and other departments of the company. The finance manager is need to create goodwill. Financial management must try to create goodwill for the company. It must improve the image and reputation of the company. Goodwill helps the company to survive in the short term and succeed in the long term. It also helps the company during bad times also. The next objective is to increase efficiency. Financial management also tries to increase the efficiency of all the departments of the company. Proper distribution of finance to all the departments will increase the efficiency of the entire companies. The next objective is financial discipline. Financial discipline means to invest finance in different sources. This will bring higher returns to the company and to avoid wastage and misuse of finance. Financial manager should concentrate to reduce cost of capital. It tries to borrow money at a low rate of interest. The financial manager must plan the capital structure in such a way that the cost of capital is minimized. Reduce operating risk. There are many risks and uncertainties in a business. The finance manager must take steps to reduce these risks. He must avoid high risk projects. He must also take proper insurance also. The last objective is to prepare capital structure. Financial management also prepares the capital structure. It decides the ratio between own finance and borrowed finance. It brings a proper balance between the different sources of capital. Next, we are going to discuss the relationship between financial management and other functional areas. The first functional area is production department. The financial management and production department are interrelated. The production department of any firm is concerned with the production cycle, skilled and unskilled labor, storage and finished goods, capacity utilization, etc. The cost of production assumes a substantial portion of the total cost. The production department has to take various decisions like replacing machinery, installation of safety devices, and all the decisions have financial implications. The second department is material department. It covers the areas such as storage, maintenance and supply of materials and stores, procurement, etc. The finance manager and material manager in a firm may come together while determining economic order quantity, safety level, storing place requirement, stores, personnel requirements, etc. The cost of all these aspects to be evaluated. The finance manager may come forward to help the material manager. The next department is personnel department. The personnel department is entrusted with the responsibility of recruitment, training and placement of the staff. This department is also concerned with the welfare of the employees and their families. This department works with finance manager to evaluate employees' welfare, revision of their pay scale, incentive schemes, etc. The next department is marketing department. The marketing department is concerned with the selling of goods and services to the customers. It is entrusted with framing, marketing, selling, advertising and other related policies to achieve the sales target. It is also required to frame policies to maintain and increase the market share, to create a brand name, etc. For all this, finance is required. The finance manager has to play an active role for interacting with the marketing department. The next department is accounting department. Financial managers play the game for managing a firm's financial and real assets and securing the funding needed to support these assets. Accountants are the game's scorekeepers. Financial managers often tune to accounting data to assist them in making decisions. A company's accountants are responsible for developing financial reports and measuring that assist in managers in assessing the past performance and future directions of the firm and in meeting certain legal obligations such as the payment of taxes, etc. The next department is economics, financial management and economics. There are two areas of economics with which the financial manager must be familiar, like microeconomics and macroeconomics. Microeconomics deals with the economic decisions of individuals, households and firms, whereas macroeconomics looks at the economy as a whole. The typical firm is heavily influenced by the overall performance of the economy and is dependent upon the money and capital markets for investment funds. Financial managers should recognize and understand how monetary policies affect the cost of funds and the availability of credit. The next one is financial management and mathematics. Modern approaches of financial management apply large number of mathematical and statistical tools and techniques. They are also called econometrics. EOQ, discount factor, time value of money, present value of money, cost of capital, ratio analysis and working capital analysis are used as mathematical and statistical tools and techniques in the field of financial management. So, each and every department coordinately work with the financial manager and make a success of the business concern. Next, we discuss the topic liquidity versus profitability in financial management. Liquidity means that the firm has adequate cash to pay bills and when they fall down due and sufficient cash resource to meet emergencies and unforeseen demands at all times. Profitability goal on the other hand require that the funds of the firm be so utilized as to yield the highest return. So liquidity and profitability are conflicting decisions. When one is increases, the other decreases. More liquidity result in less profitability and vice versa. This conflict financial manager has to face as all the financial decisions involve both liquidity and profitability. The next topic is the relationship between risk and return in financial management. Risk means is defined as a variability of the expected return from the investment. Return is measured as a gain or profit expected to be made over a period at the time of making the investment. The relationship between risk and required rate of return can be expressed like return equal to risk-free rate and risk premium. Risk-free rate is a compensation or reward for time and risk premium for risk. Risk and return go hand in hand. Higher the risk, higher the required return expected. It is only an expectation at the time of investment. There is no guarantee that the return would be definitely higher. If one wants to make an investment without risk, the return is always lower. For this reason, only deposit in a bank or post office carry lower returns compared to equity shares. So every financial decision involves liquidity and profitability implications which carry risk as well as return. The quantum of risk differs from one's decisions to another. A particular combination where both risk and return are optimized is termed as risk-return trade-off. In other words, risk and return trade-off refers to the level of operations at which shareholders' wealth can be maximized. So, when the liquidity is increased, the profitability is decreased, but the risk and return it both travel in the same directions. Risk is increased and return also increased. Risk is reduced, return also reduced. So these are the overall view of financial management.